If you are an options trader, you know that making the right decision is key to success. The good news is there are 5 questions you can use to instantly improve your trading. And the first one is, does this trade fit my system or my strategy? When you're evaluating a position, it's important to ask yourself that question. Does it meet all the criteria of your trading approach? Are there any risks associated with this position that would compromise your risk management levels? Is there enough liquidity in the market so you can get in and out quickly? You got to answer all these kind of questions before you enter a trade. I just published a video using trend lines with trading options, and just using that, you could design a trading strategy around this simple technical tool. It not only has objective entry points, but it also highlights areas for trade management or just closing out your position. It's also important to consider other factors such as volatility and time decay when you're determining if a position fits your system. Volatility measures how much price movement an asset experiences over time. Time decay refers to how quickly an option's value declines over time. Understanding both of these concepts is essential for making proper decisions about entering and exiting your position. Additionally, it's also important to evaluate the potential reward versus the risks when you're considering a trade. And it might be tempting to only go for high returns, but it's important to remember that higher returns often come with higher risks as well. Before you enter a position, make sure that the reward, or the potential one, outweighs the risks that are associated with it so you can maximize the profit potential but also minimize losses. At its core, trading is all about making sure that each of your trades remains compliant with the overall guidelines of your system, also helping minimize potential losses in your overall portfolio. So by asking yourself whether or not each position meets your criteria before executing any trade, you can protect yourself from unnecessary losses and increase your chances of success in the markets. Second one, which options expiration cycle matches your outlook? When selecting your expiration cycle, it's really important to consider your overall outlook for the stock and how much time you feel it needs to become profitable. Shorter expirations can be beneficial because they allow you to time your trades without taking undue risk, where longer expirations, they have more flexibility, but they're going to require more patience and capital. So for example, if you're looking to make a quick move off of news or something else, shorter expirations are probably preferable because they're going to expire before any major trend happens. But if you're expecting a sustained trend in either direction, then the longer expirations may suit your needs. That being said, there's no one answer when it comes to choosing your expiration cycle. It just depends on your personal preference and your outlook for the stock or the ETF in question. Another factor with that is how much capital do you have available? Longer term options are generally going to require more capital than shorter ones because there's going to be higher premiums associated with them. So this means that traders that are working with limited capital, they may have no choice but to use the shorter term options regardless of their overall outlook for the stock or the market conditions. At NetPicks, we actually teach our traders to look at about 20 to 60 days out from when you put the trade on. So this allows us to be patient without time decay eating us up too quickly. So understanding which cycle you need, it's key when you're looking to maximize your profits, minimize your risks. By asking yourself which cycle, which expiration date best fits your outlook, you can ensure that you're always using expirations that match your goals and your preference, whether they're short-term or long-term. This will increase your chance of success with your trading. With so many different cycles available for expiration dates, there's something for every trader regardless of their strategy and their objectives. Question, which option strategy will be suitable? Well, everyone knows that when it comes to trading, it's important to maximize your profits and minimize your risk. But when it comes to options trading, which strategy is going to best help you get that? Let's look at some of the strategies available. Vertical spreads, probably one of the most popular strategies for traders looking to maximize profits and minimize risk. So with this strategy, you buy one option, you sell another option at a higher strike price, or you sell an option at a lower strike price and buy an option at a higher strike price. So this type of spread allows you to capitalize on volatility while still limiting your risk by capping both your upside and your downside potential. So we prefer using vertical spreads over straight up buying calls and puts because vertical spreads can give us multiple ways to make money with the same trade. They're also less capital intensive as the way that we set them up. They're often 50% cheaper than calls or puts. The credit spreads, these offer 5 ways to make money, all while having a defined risk and letting time decay work in your favor. And this is really a great way for income producing trades. Straddles just involves buying both a call and a put option, same strike price at the same time. Now, this is a great way to capitalize on high implied volatility without having to predict any one direction. Also has limited risks because if the stock moves too far in either direction, you just limit your losses by selling your position. Iron condors, again, good way to maximize profits and minimize your risk. With these, we sell both a call spread and a put spread at the same time with different strike prices to make money off of changes in the implied volatility or the direction of the market. Again, it has limited risks because if the stock moves too far in either direction, close out your position. And when it comes to maximizing profits while minimizing risk, there are several strategies that are available depending on your market conditions and your own personal preferences. The vertical spreads, they provide multiple ways of making money. We still keep our risk defined. Straddles, they're going to allow you to take advantage of high volatility without having to predict market direction. Iron condors, good way for traders to make money off of changes in implied volatility or market direction. Not a whole lot of risk. No matter what strategy works best for you, you got to understand which one will suit each specific trade. It's pretty key for your success. And I'm going to say that at NetPicks, vertical spreads is our preferred way of trading. Liquidity, is there enough? Well, liquidity levels are an important factor to consider before you enter a trade. And liquidity refers to the number of contracts available at any given time on an option market or an ETF. Having enough liquidity, it's key to ensure that you can exit your position when you want to, and you get in at a pretty decent price as well. Now, we want to make sure there's enough contracts that are available to meet your needs. Without adequate liquidity, traders may find themselves unable to exit positions when they need to avoid losses or just to capture their profits. This can cause you to miss out on potential gains or incur unexpected losses if that market becomes volatile. So how do we check these levels? So before entering any trade, check the liquidity levels of the option you're considering buying or selling. And you do that, look at the open interest. And that refers to the total number of contracts that are outstanding for a particular security or instrument. The higher the open interest, the more liquid an option is likely to be. It means it's going to be easier to enter and exit positions without having a whole lot of slippage. That's the difference between what you expect the price will be and what you actually get in NetPicks. We like to see at least 30 times the open interest compared to contracts. So for example, if I want to trade one contract, I got to see open interest levels of at least 30. The more open interest, the higher the volume, the tighter the bid-ask spread is. In trading, a few cents here and there, they can add up. Remember, the bid-ask spread is 5 cents. That's $5 for the entire contract. Another way you can look at liquidity levels is the bid-ask spread. And this is going to tell you how wide or narrow the gap between the buyers and sellers is probably going to be at any given time. That's also going to affect how easy it is for you to get in and out of positions. And volume stats, the higher the trading volume for a particular option, the more liquid it tends to be as well. Liquidity plays an important role in trading. Without enough contracts available, you could find yourselves unable to enter, exit your positions when you need to without incurring large slippage costs or even just missing out on your potential gains due to volatility in the market. To avoid that, always check your liquidity levels before you get into the trade. Where are you going to get out? Trading can be a lucrative way to make money, but it also requires a lot of discipline and it requires a strategy. One of the most important steps is knowing when you're getting out. An effective exit plan should include clear stop loss orders, profit-taking orders, and you can use those as a guide when you're making decisions about your position. And also when you have these targets, it keeps emotions out of the decision-making process. Now, the most important part of any exit plan is your stop loss. And this refers to the maximum amount of money you're willing to lose on any given position before automatically closing it out so you don't lose any more money than you intended to. And without having a stop loss, it's really easy to get too emotional and end up losing a lot more money than you initially planned for. Setting your stop loss, it's got to be done with both short-term and long-term trades in mind. So you can quickly close out positions if you need to, and you don't have to worry about missing out on potential profits if that trade continues to go in your favor over time, because risk management is the most important. So for example, anytime I buy a call or a put or a debit spread, I know I'm going to limit my losses to 50% of what I pay to put the position on. So when you combine this with the fact that we're targeting 100% returns on the winning trades, it takes a lot of pressure off of your winning percent. You don't need to win 80% of the time to make money. And learning how to take a loss, that's a huge step in becoming a successful trader. Making sure your winners are larger than your losers, it's also an important formula to have in place. Profit-taking targets, you got to set them. You got to know when you're going to get out in profit. And this refers to the amount of money you want to make from a trade. So for example, if you set a target of 10% profit on each trade, simple. Once you reach that mark, close out your position rather than just letting it ride and hoping of more profits down the road. But as I mentioned, we like to target 100% returns with calls, puts, and debit spreads. We're not always going to get them. We're not, but that's our goal. When we set these targets, it ensures that we don't don't get too greedy. We don't get too emotional when making decisions. It keeps you focused on your overall goal. Finally, you got to be flexible with your plan. It's important to remember markets are always changing. That means your exit plan may need to change depending on what happens with the market. So keeping an eye on the market news, changing in the trends, that would help you adjust your stop loss orders, take your profits a little bit early, just depending on what's happening. And this is going to help you stay ahead of potential losses or missed opportunities because you quickly adapt. An effective trading exit plan, including your clear stop loss orders and your profit taking, while remaining flexible enough, it's good. So by having this kind of strategy in place where you're flexible, you're better prepared for whatever comes your way during the market hours. Helps reduce stress, increase your profits. To wrap this up, trading options, they can be pretty lucrative, but can also be very risky if you don't do it right. Luckily, just asking yourself simple questions, like the 5 we just talked about, that can instantly improve your chances of success. So not only do these questions provide insight into the market conditions, but they also help ensure that you stay disciplined by adhering closely to your predetermined strategies and your parameters set every step of the way. This means that no matter what happens during the market hours and your trade is on, you're always prepared. And if you're looking to get started in the markets, Dynamic Duo has your back, and it's a downloadable guide. You're going to have all the information you need to trade 2 highly successful markets and potentially see some pretty good profits. Plus, it also has our 1-day options trading strategy. More potential for success there. You don't have to wait. Just download it now. It's free. The link is to the left here or in the description below. Thanks for watching.